Good afternoon, everyone. I want to welcome everybody to the regular scheduled meeting of the Kentucky County Employee Retirement System Board of Trustees meeting. Sherry, if you don't mind, can you, Eric, can you read our opening statement, please?
I can. This is a regular meeting of the County Employees Retirement System Board of Trustees. This meeting is being broadcast via video teleconference pursuant to KRS 61826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public live via Facebook. If you are speaking and are not appearing by video, please identify yourself before talking. If the video or audio broadcast is interrupted, we will attempt to reestablish a connection. Connection cannot be reestablished within 30 minutes. The meeting will be adjourned and rescheduled to a later date.
Okay. Thank you. Sherry, you mind to take the roll, please?
Yes, sir. Mr. Cheatham?
Here.
Dr. Carver?
Here.
Mr. Foster?
Here.
Mr. Fulkerson?
Here.
Dr. Hackbart?
Here.
Dr. Milkman? Mr. O'Mara?
Here.
Ms. Pendergrass?
Here.
And Mr. Powell?
Here.
Thank you.
Okay. Being a quorum present, we'll go ahead and move forward. Sherry, were there any public comments?
No, sir, no public comment.
Okay. You had distributed in your packets a set of minutes from the May 28th Board of Trustees meeting. Are there any adjustments, changes that need to be made? If not, I'll entertain a motion to accept as presented.
So
moved.
There was at least one motion and I assume a second. Was there a second?
Second.
Second by Miss Betty. All in favor signify by saying aye.
Aye.
All
Aye.
opposed? The ayes have it, minutes passed as presented. I have this little segment in the agenda, really don't have a whole lot to update you on. Would like to draw your attention, if you've not already gotten one, we have a continuing ed meeting scheduled for July the 17th. Wilshire will be doing the presentation on board governance. We've asked them to highlight several different areas as far as best practices. So please try to make every effort to try to be there. We're also working on a couple of other continuing ed sessions, one with specific to House Bill 484, and another one that we're working with Ms. Surratt with regard to just covering benefits, pension spiking, particularly now that there's been some changes in that area. So as soon as those get scheduled and on the books, we'll certainly get that out to you and make sure it's convenient for everybody's schedule. Sherry will also be emailing you a lineup. I've talked with each of you, and I know each of you know what committees that you're going to be serving on, but thought it would also be helpful for you to see who's on the other committees as well. So she'll be sending that out to you shortly. The other thing I've got, just wanted to let you know we are continuing to have conversations with different participants and partners in the programs. We had a nice little conversation this morning with Larry Totten from the Kentucky Public Retirees. I want to thank Larry for reaching out to us and coming in and just kind of talking about the different things that they're concerned with. And I thought it was a very good meeting. So with that, I want to move on into the next item on the agenda, which is the fiscal year CERS planning letter. Mike, you want to take that over?
Yeah, so Who we have with us today is Ryan Graham from Balloon Company. He's the partner or the director on the ACFR audit, one for the CERS system and the Kentucky retirement system. So this letter here is required communication, and I'll let Ryan take over.
Good afternoon, everybody. This will be pretty brief. You've got the quick 3-page letter here for you. The primary thing is just to introduce ourselves. We're back after a year break, and we appreciate the opportunity to be back. I know the APA did the audit last year as required. This letter just primarily is to open a two-way dialogue between those charged with governance and ourselves. My work line is in the last paragraph. If you ever need that, please feel free to use it, along with my email address. This letter just communicates some of what our responsibilities are for the audit, that we will consider the internal controls of the system, identifies what the standard and what we identify as the risks with the system audit, and then gives some of the timing that we're working towards. So pretty standard language for this letter. Like I said, it does include my contact information. If you ever have a need to reach out to me, please feel free to use that. That was all I really had. We're in the very early stages of planning the audit. We met with a number of members of the KPPA team. I think that was about 2 weeks ago, just to start some initial planning conversations, getting these letters going, and we'll be digging in here in the next couple of weeks to get really digging in on the audit. I'll entertain any questions anybody has. Like Mike said, we are doing a CERS specific audit this year, which I think is a little bit of a change, and I believe you previously discussed that as well.
Ms. Pendergrass has her hand raised.
Yeah,
Good afternoon.
Since the administrative system is a consolidated system, will the test of transactions and internal controls be consolidated for all systems at one time, or are you doing separate tests for each of the 3 systems?
So the detailed testing, so like census data and things like that, sampling for investments will be considered separately. Internal controls, if it is the same control system between the 2 systems, there is the potential that, we can walk through the systems together and understand internal controls, since it is administratively the same between the 2, but the actual testing of contributions and benefit payments will be separate.
So when you say between the 2, you mean CERS and KRS?
Yes.
Thank you.
Ryan, I picked up in the KPPA meeting, you all were going to be sending letters out to trustees. Was that specific to the KPPA trustees, or does that include CERS trustees?
So that was the CERS trustees, and that's the letter that's currently on the screen. It was in the board package. And then the engagement letter has been sent and signed by KPPA, engaging us to complete the 2 systems, KRS and CERS.
I took it that you were sending out survey letters asking for input from the trustees. Is that not part of your audit process?
So the planning communication letter here, we will send some standard fraud inquiries to a member of governance. So that will come as we get into audit procedures. We're still in the early planning phases right now.
Okay. All right. Any other questions for Ryan or Mike? Hearing none, I don't see that there's nothing for us to prove here. Is that correct, Mike?
Nope, it's just required communication that that Balloon Company is presenting to the governance officials, which is the trustees of CERS.
Okay. All right.
Thank you all.
Mike, I believe you're got item 8, the hybrid percentage CRS allocation.
Yes, I do. I do want to let you know that Ryan from Blue will probably drop off the call now that his time is no longer needed. This particular memo here is for the CERS Board of Trustees to approve their internal allocation of the hybrid percentage. So currently the budget work group or the budget ad hoc committee that is been appointed under KPPA is responsible for coming up with the allocation of system costs between CERS and KRS. And they have concluded that the overall hybrid percentage for fiscal year 25, which will begin July 1, will be 64.16% for CERS and 35.84% for KRS. And they will be presented to the KPPA board for final approval on June 27th. In the meantime, rather than come back and have you approve your own internal allocation, I am presenting the internal allocation for CERS of that 64.16%. So the CERS non-hazardous plan will be 59% and the CERS hazardous plan will be 5.16%. That's based on the head count of those two plans. And that's how it was allocated internally last year and in the year past within the CERS system. Sherry, okay, perfect. I think we're good. For there is also the comparison of what that percentage was last year for the non-hazardous and the hazardous plan. So what I'm seeking today is a motion for approval of those internal allocations based on the upon approval of the KPPA's overall allocation on June 27th.
Move for approval.
Got a motion,
Second.
seconded by Bill. Any questions, discussion? Hearing none, all in favor signify by saying aye.
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 All opposed? Ayes have it. Thank you, Mike.
Thank you.
Okay. Item 9 on the agenda is the second reading of the CERS bylaw changes. If you recall, the last meeting, we had made the adjustment to specifically allow for up to 5 members on each of the standing committees. Are there any questions, discussion on this item? Hearing none, I'll entertain a motion the bylaw changes to be approved.
So moved.
Second?
Second.
Motion and a second. Any questions, discussion? All in favor signify by saying aye.
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 All opposed? Ayes have it. Second reading of the bylaw changes been approved. We'll move on now into item 10, which is investments. Dr. Hackford, you'd like to take over at this point?
Thank you very much. The investment committee met on June 4th and considered 2 items for discussion and action, and also had a report from Steve regarding the 3rd quarter of this fiscal year, overall performance, as well as the first 2 months of the 4th fiscal year. So we had a relatively full meeting. In regard to the 2 items, the first one, of course, was one that this committee has already seen, and of course that was the fact that there had been a recommendation that had been forwarded from the investment committee to the 2 full CERS committee regarding some adjustments in our asset allocation policy. But if you recall, at that meeting there was considerable discussion, and there were several items that basically I think the full committee, the CERS committee, felt would be worthwhile for the investment committee to have further discussion and consideration. So that recommendation was sent back down to the investment committee, and that was one of the items we considered on June 4th. And we had a very active discussion of the asset allocation recommendation. We had an additional presentation by Wilshire and also by Steve and staff, and a very lively conversation about that potential recommendation that we would forward back to this committee. And after due consideration, the committee voted to forward, it's referred to as the lower risk item, option A, to this committee for consideration with the recommendation from the committee. However, during the conversation, there was also consideration of another option that was proposed, and that was that there would be an adjustment to the asset allocation recommendation that had been considered by the committee and also by the full CERS board at this board's previous meeting. And that would be to reduce the target for specialty credit from 23% to 20%, and to move 3% allocation to core fixed income. So that core fixed income would have a total then target of 13%, especially credit would have a target of 20%. And of course, if you recall, the recommendation that had been forwarded to this committee was for a reduction in the focus on public equity from 50% to 45%. Those were the major changes that were discussed, and we had a full discussion of those and decided that with that recommendation of option A plus maybe consideration of the proposed suggestion of maybe making a further adjustment to that recommendation be considered and evaluated by Wilshire and staff for this meeting. In addition to that action, the committee also considered a staff recommendation to change the benchmark for internally managed large cap public equity from the S&P 500 to the Russell 500. It was suggested during that meeting that in effect there's a lot of overlap between those two options for a benchmark, but the staff felt that the Russell 500 was probably more appropriate given the approach that we're using in our investment strategies and so forth. And that was approved by the committee. We're not sure whether that actually requires action by this board, but we're referring it to you for your consideration. If you feel it's important to approve that as well, we're certainly amenable to that. In addition to those two action items, Steve provided a quarterly update for the third quarter of the current fiscal year, plus the update for the first 2 months of the fourth quarter of this fiscal year. Among the comments that Steve shared was that growth assets had a very strong quarter in the third quarter. Especially credit was also strong. During April, the first month of this quarter, was a difficult time for the market, but in effect there was recovery during May. So overall, so far this quarter, we're doing well. Joe Gilbert also discussed the recommendation for the benchmark change and did a very effective job in that regard. So in effect, as I indicated, that was approved. So Mr. Chairman, basically we have one action item, and that is to change the asset allocation strategy or policy with the possibility of encouraging maybe discussion of an option that was discussed also, and that was to make a slight adjustment to the asset allocation that was considered by this board at its last meeting, and that was to move a 3% allocation from specialty credit to fixed income. So I'm not sure how we proceed. I guess there could be a motion or maybe further discussion of both of those options before we have a motion to proceed in one direction or the other. So that's the report from the investment committee.
Here's the boardroom is muted.
Is there somebody on here from Wilshire?
Yes, you have several of us on.
Okay, Craig, if you don't mind, if you want to kind of go through, because we asked you to go back and model that 3% adjustment. Do you want to spend a little time just kind of talking about that and then comparing it maybe to where we are right now? That way
Sure.
everybody will be ready to move forward.
Sure, happy to do that. And I think page 34 of the materials is the perfect picture's worth 1,000 words, right? So just to be clear, the way that memo page we were just on before, it read as if the portfolio with the modifications was what was approved. I believe lower risk A, which we see here in the green dot, is what was approved, and the reddish dot was more of a for additional information exercise, which is what Dr. Hackbar just said in his comments. But just in case the memo wording didn't quite line up with what he was saying or what our understanding from the IC was, that green dot, which you can see is on the efficient frontier that has a 45% floor to public equities. That's an efficient portfolio, lower risk A. The modification to move that 3% from specialty credit to core fixed income moves you a little bit off of the efficient frontier. So it's from a mathematical perspective, that's not an efficient allocation of your capital. It does cut your risk somewhat, but at the same time, it cuts your return. And since you're not on the frontier, there would be a more efficient portfolio mathematically that would be available to you at that level of risk. So we've included this chart here. You can see on the far right is your current portfolio, the blue dot, and the blue curve there is an efficient frontier with 50% equity. And we see with a higher floor to public equities, if you force the portfolio to take that higher public equity, you're decreasing your return per unit of risk. So again, that's the impetus for this whole exercise, that public equities, when you made that allocation, that blue dot was on the efficient frontier. The market environment has changed, and that's why your portfolio is now sitting there off to the right at a higher level of risk, given the return that you're able to achieve. There are better options today. Just as a reminder, we've gone over this in the past meeting, I believe, that the change in interest rates we've seen in the last few years is the main driver there. Public equities have done exceedingly well. It was a good move to move higher into public equities when you did, because fixed income was offering very little. Now that dynamic has changed, and therefore the lower risk A portfolio shifts from equity to fixed income now that trade-off has swung in the favor of fixed income. So I'll leave it there, keep it pretty brief. There's more data on the next 2 pages, but like I said, a picture's worth 1,000 words. So happy to answer any questions if there are any at this time.
I would also note that it's noted in the material, but I would highlight that all of the modeling was updated from the last time we presented to the board. At that time, we had used 630 of 23 capital market assumptions, and all of the current modeling, including this information portfolio, was updated using 331.24 capital market assumptions.
Okay. You may have questions for either Steve or Wilshire.
I guess maybe just one question. I think in the proposal, in addition to the change in terms of public equity and also especially credit, also were there some suggestions for changes in real estate and real return. If I understand correctly, the suggestion is that the proposed target for real estate be adjusted downward from 7% to 5%, which seems reasonable given the fact that the outlook for real estate doesn't seem to be particularly appealing. I guess the other highlight would be in terms of real return. The current target is 13%, and the recommendation is to reduce that relatively significantly. I was just wondering, Steve, would you have any further comment about your thoughts in terms of why you might that might be reduced, aside from getting closer in alignment with what we're actually doing?
Sure. I think at the last asset allocation that was adopted, as Craig mentioned, was really focused on building an efficient portfolio in a very low rate environment where a number of plans, not just CRS, were really required to stretch out the risk spectrum in order to achieve assumed rates of return. There just wasn't much yield available in the world. And one of the large changes, so the big change at that time was a reduction in specialty credit, an increase in public equity, and kind of a corresponding increase in that real asset bucket. We've moved forward with deploying capital there. As we know, we had 3 new real return managers approved last year, and they've been calling capital. So we're much closer to what that revised target is. But I think the recommended and the approved asset allocation is certainly not dependent on where we currently are invested, but on what the prospective outlook is for those asset classes. And as we've seen from the shift from the last time that the asset allocation was adopted relative to currently, that real return bucket has an inflation component to it, and some expectations as to the future path, which feeds through to what the expected returns and the associated expected risks are with that. So from an efficient and optimization standpoint, that's one of the asset classes that kind of is a linchpin here for the change. And given the expected return for that asset class relative to the other options available in building that optimized portfolio, it's just one where there's a reduction necessary to achieve that portfolio.
I guess maybe related to that, Steve, if you would, we've talked in the past about the kind of the borders or the range, for example, on public equity. And I think we talked maybe about 5% range. We wouldn't be terribly concerned if we're not on the target, if we're within that range. In terms of the smaller allocations, for example, real estate and real return, what are your thoughts in terms of the range that you would see going forward in terms of managing those particular component parts of the asset allocation?
Sure. Wilshire does a really good job about, kind of implementing a methodology for establishing ranges across asset classes. And those both have a magnitude relative to the target size, as well as a volatility aspect to it, a liquidity aspect. I would anticipate that, we tend to be more active in utilizing ranges in more of the liquid asset classes. Obviously, the time and the cost in making material changes to the less liquid or the private asset classes can be a pretty high hurdle for taking significant positions, deviations from the target. So we tend to manage more closely around those targets. Obviously, if we look at the history of the portfolio, even over the last 4 to 5 years, we've had a very tactical short to real estate. That's one that we've implemented that hasn't changed. That was based on views of the risk and the return for that asset class. That's worked out pretty well. That's something we could establish. It's tough to be tactical in those asset classes, but it's something that's a little bit more structural in nature, somewhere between those two. But our guide would be to operate within those ranges. But again, you would typically see more activity from a positioning standpoint in the more liquid asset classes, and probably closer to targets in the less liquid asset classes. The ranges for those smaller allocations will be much tighter. Obviously, if we look at the ranges that we had for the largest single asset class, which was public equities, that was a pretty broad range. And as we see, when we get narrowed down to something that's targeting a 5% allocation, we're going to have a much narrower range around that target.
I guess my follow-up question on that, Steve, just for information purposes, would be, with those ranges, should they be included in our policy statement and adjusted accordingly, or are you better off from an operational viewpoint, in effect, simply having an understanding that the ranges vary by different types of assets, so that you have the flexibility that you need to make those adjustments? I guess I would just be interested in your thoughts.
I think from a flexibility standpoint, we prefer a wider range to be able to implement some discretion within those asset classes. But I think it's important that the IC and the board approve and establish those ranges. I mean, I think there's some consideration you may have as to, we certainly don't want to go below or above a certain amount in a certain asset class. And we've talked about this in the past. There's no real reason that we have to have symmetry around the targets as far as the ranges. We can have some asymmetry as to, we don't want to, a tighter downside or tighter upside for particular asset classes. So I would look to the investment committee and the board with obviously input from Wilshire. Again, they do great work in that area, and input from staff. Having a very wide range in an asset class, that's something that we wouldn't take advantage of or necessarily would anticipate market volatility to cause us to breach, is probably not necessarily worthwhile. So I think we want to be cognizant of the desires of the investment committee and the board as to establishing those ranges, kind of with input from Wilshire and from staff. So I would be in favor of establishing those ranges. Obviously, they're part currently of the IPS. I would think that would be how we would move forward as well. They would be established ranges. Again, I think we can always go, and we have in the past, request approval from the IC and the board if we wanted to go beyond those ranges for a period of time. I think that coming to you and seeking approval to do so is how we should operate. So that's what I would see going forward.
Well, good, Steve. I think it's something that we've talked about during the deliberations about adjusting our asset allocation, but we really haven't zeroed in on it. So maybe something we might want to put on the agenda for maybe the investment committee to talk more about that and maybe develop a recommendation either that could be used for your use, or maybe we want to more formalize that. But it's something that we've talked about, but we really haven't zeroed in on. So I thought it might be something we might want to highlight this afternoon. So thank you. I appreciate that, those comments. Mr. Chairman, those. Yes.
I'll just add a piece if I could. This is David with Wilshire too.
Sure. Thank David. Thank you. Mm-hmm.
Yeah, sure. Just sort of reiterate everything Steve said. We do think it's important that a board has policy ranges in the IPS, and you do, as Steve said. And generally, what we've done, in fact, we've already started on this here, is that after a policy is approved, we'll revisit those ranges with all of those things that Steve talked about in determining what those ranges should be. So I would just say, to the first part of that, we believe strongly that they should be part of the IPS, and they are in your case. But we'll continue to work with you and staff on addressing those again relative to this new policy that you would approve.
Good, fine. I guess that's where I was headed. Thank you. Mm-hmm.
Any other?
Mr. Chairman, back to you, I guess.
Any other? Bill, I believe you got your hand up, sir.
Okay.
Well, thanks. I just want to revisit my fascination with our current allocation, not our current asset allocation approved. I keep wanting to see where we are now and where we're proposing to go instead of where we were supposed to be and where we're going to go. So I would really like, on when you present page 35, comparing options and the current approved allocation, that if you would also put in there what our percentages in each category really are, so we know how much change would be engaged in order to meet the new approved allocation. I find that really valuable in trying to evaluate the information. So there's my spiel.
Well, I apologize for not including that. The last time we did present to this asset allocation to the board, we did include that. I can say that we haven't had material changes to any of those asset class actual investment levels since the last board. But I'm happy to answer if you're specifically regarding any of the asset classes, if you're looking at where our current allocations are. Happy to answer that if there's a specific question.
No, I found it on page 102, but it would have been nice it was been on page 35. It would have saved me some time. I also would have found it very beneficial if it would have been in the graph on page 34 as well.
Yeah, just anecdotally on the graph, because your target to specialty credit is lower than where you're allocated currently, that's going to be something that would cut risk and boost return given our current outlook. So I'd expect that the portfolio, this blue dot you hear, would be shifting up and to the left because of that overweight. Not too far because you're still containing that 50% public equity, even a little over target is pulling you up the risk spectrum. But that's probably that would have been the biggest driver from your target to your actual. But good feedback. We'll make sure to include that in these charts going forward.
Appreciate it.
Ms. Pendergrass has a raised hand.
Yes, Betty?
I just wanted to clarify the motion at the investment committee. I thought that the motion was to change the lower risk A categories so that specialty credit was only 20% and that extra 3% was going to go to core fixed income. So I thought the motion was the last column on this page and that was the allocation that the investment committee approved.
I did go back and listen to the investment committee, and I think while it wasn't maybe not entirely clear, I believe that the IC approved lower risk A to send to the board for ratification with the caveat that the additional information that's in that last column be provided to the board for discussion.
I agree. I thought that was what we decided on.
You know, we could, if that's what we're heading toward, we could make that as the motion. And then we clarify it that way, Betty and Bill.
Yeah. I understood it was, as Steve stated, that we were presenting it for information because we needed them to run the numbers so we would know what the expected return is and Sharpe ratio would be.
I agree with both Steve and Will. That's how I intended the motion, because we didn't have the information for that 3% adjustment. My intention was in the motion that we approve A, but with the option to look at the 3% adjustment, not knowing the numbers, where that would put us with regard to both return and risk level. So, and looking at what one thing I looked at that, you know, I'm obviously as much about getting the best return we can as anybody else, but I'm certainly about getting the return with the less risk associated with that portfolio. And you know, the lower risk A, as Craig pointed out, we're looking at about a 1 point difference in standard deviation, which in our case translates into about an 8% reduction in risk. The 3% adjustment, if we look at that, reduces that a little bit further, but it also gets us off of that efficient frontier as far as an efficient return. So I don't know how well that clarifies everything, but that's what I'm seeing based on what's been presented from the revised numbers.
And I think maybe just a little more in the recall side. I think at the end of the meeting, the decision was made that we would like to forward a recommendation to the CERS board, even though we were still discussing the possibility of that 3% adjustment. So I think probably the motion got a little bit fuzzy in terms of people's understanding of it. But I think the idea was to move the motion forward with the idea that after the evaluation has been completed, we might want to make an amendment to the original recommendation to adjust the 3% shift from specialty credit to fixed income.
I agree. I think the real discussion here, I certainly want to be on the efficient frontier. I've worked with that metric for years in the industry and firmly believe in the modeling that goes along with it. Probably what we're talking about, a 3% adjustment in specialty credit versus core bond, all those things ought to, and Dave, Craig, if you don't mind to chime in, would in all likelihood fall within those ranges that Dr. Hackford was referring to that should be contained within the IPS. Wouldn't you agree with that?
Yes.
I think the other suggestion that was made and discussion that came forward in our committee was the fact that, given the fact that fixed income outlook, at least for the next several years, looks fairly attractive, and that it might make sense to adjust upward our commitment to fixed income, given the current realities of the fixed income market, if you will. And so I think that was one of the reasons that we were thinking about that possibility, rather than increasing the allocation to specialty credit.
Yep.
And lower investment costs for the same dollar.
Yes, right. So net, right. Mm-hmm.
Any other questions or discussion? If not, I'll entertain a motion that anybody wants to put forward as far as making the adjustment to the asset allocation.
I'll move that we accept the recommendation for option A with the 3% adjustment to fixed income.
Okay,
I'll second.
All right, just clarify, Dr. Hackford, Bill, you're wanting to make the adjustment, including the 3% adjustment?
Yes, the recommendation was subject to the adjustment of the 3% from specialty credit to fixed income.
So again, for clarification, we're talking about on specialty credit, because that's where the difference would lie. Our target is 20%, not 23. Is that correct?
That is correct, yes.
All right, got a motion and a second on the floor. Any questions or discussion? Hearing none. All in favor of the motion signify by saying aye.
Aye.
All opposed? Ayes have it. Okay. With that, Dr. Hackford, I know you touched on it, the benchmark. Steve, do you want to also chime in with regard to the cost savings there?
Sure. If we, sure, if you can go to page 41, I believe. Perfect. So, as Dr. Hackbart mentioned at the June 4th meeting, staff made a recommendation that was unanimously approved to change the benchmark for that U.S. public equity large cap internally managed passive portfolio from the S&P 500 index to the Russell 500 index. We have been reviewing kind of the structure of our public equity portfolio. It's an ongoing process. And one of the things we've been looking at was a bit of a misalignment between, as a legacy from our prior structure, where we had a U.S. target and an internet or a non-U.S. target, and moving to that global target, we have a kind of a mismatch of indices, and it's not a, as Joe liked to say, it's not a high nail as far as concerns from our perspective, either regarding performance or risk or volatility. But we had an opportunity. The provider of the S&P 500 index came to KPPA and brought up the fact that they're changing how they fee for use of the underlying constituent data. We had been paying a fee of $27,500 annually for full utilization of the data, the constituent level data of that index, which allowed us to manage the portfolio. They were pushing for a flat data fee plus a variable IP fee based on AUM for entities who replicate the index, and it would have resulted in a pretty substantial increase in cost for us running that portfolio of approximately $137,500 per year, with some variability to that. That's based on current AUM for that portfolio. So a pretty significant increase, and that kind of caused us to push forward the consideration that we had for aligning the portfolios. Other portfolios in that in the public equity asset allocation use the Russell indices. Part of the potential misalignment is index providers use different methodology for constructing their indices. And specifically between these two, the Russell 5 and the S&P 5, it's how they utilize capitalization weights for inclusion or exclusion from indices. And given that our other portfolios are using Russell indices, we thought there would be a better alignment, reduce unintended tracking error due to variances in construction, with the benefit of lowering costs. Joe did a lot of work behind suggesting and making this recommendation, and he showed in the deck material that it doesn't, while there can be modest or very minimal performance differences between the two indices over time, they align very, very closely, so we can get the same performance for the portfolios at a lower cost and no real change in volatility. Specifically for the indices, there are about 430 names in common, and while that seems like there's a lot that aren't, those 430 represent over 97% of the index weight. So the vast majority of the index is consistent between the S&P and the Russell. We talked about the transition. We don't anticipate any elevated cost of that. We'll make the transition over the normal course of portfolio rebalancing. So it gets us better aligned with the other portfolios in that U.S. public equity allocation. It comes at a lower cost for essentially the same performance and the same volatility and risk. And it wouldn't, there wouldn't be a cost associated with the transition above and beyond what we already do for rebalancing the portfolio.
Okay. Anybody have?
So happy to answer any questions on that.
Hearing no questions, I'll ask for a motion to approve the recommendation that we make the change to.
I'll move. Second.
A motion and a second. Any questions, discussion? All in favor signify by saying aye.
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 All opposed? Ayes have it. Thank you. Moving on to the next item, item 11, Finance Committee. Bill, do you want to?
Sure. The Finance Committee met on May 29th, 2024. It was chaired by Lyle Cheatham, and the actionable item from the meeting was hazardous duty request. And Mr. Sherratt, would you want to walk us through that, please?
Yes, I can. Today, we have 9 positions being requested for hazardous duty coverage. The majority of the requests are police and paramedic positions. We do have 1 senior deputy director position, which is an emergency management director position for Boone County Fiscal Court. KPPA has reviewed the information and believe these positions do meet the statutory guidelines for hazardous duty. Position questionnaires and job descriptions were included. The CERS Finance Committee did review these, and therefore we are requesting the CERS Board of Trustees for final approval.
And the committee recommended that the board approve as presented.
Anybody like to make a motion to approve?
So moved.
A motion by Jerry, seconded by
Bill.
So moved.
all in favor, signify by saying aye.
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 All opposed? All right. Go ahead.
The usual updates were presented and the memo goes about the conversation. Lyle, would you want to bring anything to the board's attention?
I think it was a pretty short and sweet meeting. Trying to get back to, there we go. Sorry about that. Yeah. I think, Mike, you want to give a quick overview of what was covered in the finance side of things as far as quarterly and year to date?
I'm happy to do that. I do like the memo that's presented there. It did summarize the discussion quite a bit. The assets are in good shape. They're up, driven by the changes in the investment fair value. The statement of changes shows that the fiduciary net position changed quite a bit in comparison year to year as well. The contribution report showed that both plans had higher contributions for the 9 months ending compared to the prior period. Some of that had to do with higher salaries, but also in headcount. Mr. Cheatham did ask for a breakdown of headcount by employment type, like whether it is a county, a city, school board, et cetera. So we're working on that, and we plan to have that in the next quarterly update, a breakdown of that on a year-to-year basis. We did see that the cash flow is good for the pension systems, not so much for the insurance, but that's because the contributions are low because they're funded. And I think as we got to the admin expenses, we're on target for the most part. There's a couple categories that will be over. The hearing officers for legal is already over. The personnel line item overall will come very, very close to budget. It might exceed it by just a little bit. And postage is an individual line item that is over, but overall the admin budget should be below what we anticipated and will not reach into the reserve amount that we had set aside for last fiscal year. And then we presented the hybrid allocation for the systems for you to examine. I'm happy to entertain any other questions that you may have.
I believe the other thing was an update on the budget planning process. And Pruitt Lane is representing the K systems, and I'm representing the C systems. We're meeting with Mike and his staff, as well as executive management, going through a very detailed review. You saw some of the outcomes with the hybrid percentages. We reviewed personnel, both dollars and headcount, both the budget from the budget office as well as internally. We've also looked at IT expenses, legal expenses. So a good review of proposed budgets. We're planning on having another meeting before the end of June so that a final budget can be presented to the KPPA board at their next meeting. Anything else to add there, Mike?
No, I mean, I think it's the only thing I would add is I know the reserve's been a topic of interest for most of the trustees in the past. The state cut our budget a little bit, about $1.5 million compared to last year. And with the increased costs in legal and some of the adjustments that the state's made and we've made internally to salaries, we will have very little unallocated reserve for the fiscal year 25 budget. So I wanted to let you know that it would be less. Right now, it's sitting around $215,000, where last year it was over $4 million. So I thought that was a key change to the admin budget.
Well noted.
Okay.
And I think that finalizes the finance update.
Okay.
Unless, did you have any other details on the quarter report, Mike?
No, I mean, in the finance committee, we did go through the interest invoices and what was waived and what was collected and what was billed. And if you want me to go through that, I'm happy to, but it's pretty much similar to how it's been.
Right, and I think the reference material is included. So that concludes the finance report. Thank you.
Anybody have questions for Bill or Mike?
Yeah, Mr. Eager has a raised hand, and then Ms. Pendergrass.
Okay.
I just wanted to commend Bill and Mike for just a thorough, excellent job and an ability to communicate effectively with us. This has been a process that I think just has run smoothly. It's been done properly and required a fair amount of time. So I thank you guys.
Thank you.
Appreciate it.
Okay. Ms. Betty?
I was just curious if we were going to cover the quarterly update in the investment administrative budget.
Steve?
In the investment section.
Yeah.
I'm happy to provide an update. You want to share it, page 121, I believe. Thank you. Through the first 3 quarters of the fiscal year, actual expenses continued to run well below the amount budgeted for the year, with only 41% of the budget spent year to date. Contracted service expenses remain in line with the budgets. We've continued to experience delays in receiving the BNY custodial invoices. So as of this report, only 2 invoices are reflected as being paid year to date. Adjusting for that delay, and approximately 70% of the services budget has been spent year to date. The largest difference continues to be between actual expenses and budgeted amount for legal services, with only 23% of the budget spent so far this year. We do expect legal expenses will increase as litigation activity picks up on a number of cases. Whether that's into the 4th quarter of this fiscal year or drags into the next fiscal year is kind of going to be determined by the court and how fast or how quickly some things move. So Michael could provide an additional update there, but we expect those expenses to increase pretty significantly, both from an activity standpoint as well as we know that the policy that we had that covered certain legal expenses has been extinguished. So all of those expenses going forward will be paid directly out of the trust. Page 124, please, Sherry. Investment management fees have remained stable across asset classes, with any fluctuations driven primarily by changes in market values and allocation decisions. Volatility at the total fee and expense level has been driven by large swings in performance-based fees, with increases in the specialty credit and private equity asset classes and erosion of real estate performance fees, which is consistent with the performance for those asset classes. We've also seen, as you'll note, a sharp rise in the miscellaneous expense category over the last year, and that's really for strategies that rely on credit facilities as part of their investment process, and that's given the significant rise we've seen, especially in front-end rates over the last 18 months, so that the cost of those credit facilities has gone up. The counter to that is obviously the yield we're receiving on those investments has increased in excess of that. I also wanted to note that we're starting to realize the cost benefit of managing more assets in-house. Specifically in the core fixed income fiscal year to date, management fees are $250,000 lower than in 2023, despite the significant increase in total market value. And here I would also note that the The 566,000 miscellaneous fee noted in 2023 is a misclassification, will be corrected going forward and should be included in the investment advisory fee total. I'll pause there for questions.
Mr. Eager has his hand raised.
Yeah, Steve, I would think it would be helpful if you could actually do the attribution for the savings for assets coming in. I know you say we've saved a lot in spite of the fact, but if you could do the complete attribution, say really, what is the real number? And secondly, I won't be here long, but I continue to think that this page, if somehow you could report basis point fees on.
We noted that with this quarter. We will include what is a rough estimation of the basis point fee charge per asset class. And I would note on that 250 is in total is from bringing it. So in excess of that has been saved because otherwise,
yeah.
But I'll get you specific numbers as to how much. We thought that the total at the time on an annualized basis was $1.5 to $2 million in fees that would be saved.
Be nice to see, and I know the legislature would appreciate that as well.
Absolutely. I will get those numbers.
Okay. Any questions for Dave or Steve? Okay. Hearing none, we'll go on into tab 12, staff reports. Ed?
Thank you, Lyle. I'll be brief. I do want to highlight one thing on the report, and then I'll take any questions you might have. Lyle, Mike Foster, and I met with representatives of our employers, KLC, KCO, and the school board. We're establishing that as a quarterly meeting. We had a good conversation about the direction that the C board was going, things that Lyle and Mike, under their leadership, want to see accomplished. And the employers got an opportunity to speak to the leadership about the things that they're concerned about, the things that they would like to see happen with the system going forward as well. So I thought that was an incredibly productive meeting, and we look forward to having many more in the future. So I'll take any questions about the report or anything else that anyone may have.
Anybody got questions for Ed? Okay. Dave, I appreciate you making time to be with us.
You're quite welcome. I, like Ed, I provided a written report. I do have a couple of comments. One about the report and another with that's new news that just came out today. One of the things I want to say is that there was some expression about making sure that we're getting new ideas and we're staying on top of things and looking at what other people are doing. We absolutely do that. I will tell you. In this report, we talked about 7 different conferences. We had 12 people go into 12 slots. So there's trying to avoid duplication and trying to get as many people as we can exposed and to get as much coverage as we can. I will tell you, this morning in a meeting, we were talking about a particular enhancement, and the discussion went to Rebecca, who said, I talked to so-and-so from the state of Missouri, and we're going to follow up and get some information. I could let her speak for herself, but essentially, we are not tone deaf to what other people are doing. We're very actively talking and looking for ideas. Second comment I'd make is this morning we came out with the June retirements, which means now we have the tentative retirements for all of fiscal 24, and there's kind of interesting data. I wish somebody could explain it to me. Aaron, maybe you're the one that can do this. But in fiscal 23, C retirements were up just about 3%. In 24, they're down 12.
Caroline Eager.
And And for K in fiscal 23, K was down 23%. Remember, C was up 3. This year, K's flat. So we have a big exchange of what's going on in terms of the systems that are having a decline in their retirements. But beyond that, I'm happy to answer any questions.
Anybody have questions for Dave? Okay. Dave, appreciate you, like I said, joining us today. With that,
You're welcome.
I'd like to move on to item 13. Need a motion to go into executive session pursuant to KRS 61.810C to discuss pending litigation.
So moved.
Got a motion by Jerry and a second by, thought I heard somebody.
I'll second the motion. It's Mike.
Second by Mike. Okay, all in favor signify by saying aye.
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 Opposed? Ayes have it. A motion having been made in open session to move into a closed session for specific purpose. And such motion having carried the majority vote in open public session, the committee shall now enter closed session to discuss pending litigation pursuant to KRS 61.810C.